Welcome back, everyone. I know this is a different setting from our normal videos, but I just wanted to put this out to kind of cover a few important topics. Really just going on with like the whole bank situation and what we could potentially be facing going into this week. Number one is we could certainly see a liquidity pool on the markets, a pull on the markets. These companies that are tied in with SVB, they are venture capitalist companies. They are not. It's not similar to like a consumer bank where you and I open accounts. So these accounts have very large amounts of capital in them, more so that will need to be available for these companies to operate, do things like maintenance, make payroll, all that kind of good stuff. That's why over 97% of them have over 250K. Right? And most people don't have that kind of money. So we're talking about institutions here. These institutions are going to need to make money. We could see a bailout from, hopefully not from the government, but we could see one from hedge funds. Hedge funds can do a buyout where they pretty much turn over the account, and they're able to it wouldn't give them 100% of what they would need. Let's say they needed like 15, 20 million. Hedge fund would come in and give them 10, and if the government, FDIC, and all that come to a bailout or an agreement or whatever, and they give, let's say they give them the 15, 20 million, the hedge fund gets to keep the difference, but the companies get that capital up front, right? So that they're not pretty much, scrambling on Monday and Tuesday. It kind of gives them that flush of cash that they need while things get sorted out, because it's typically not a very quick process to sort these types of things out. So you'll start seeing some payments possibly come in from the FDIC early this week, but it's not going to be to the tune of a company that has, let's say, $30 million in there, and the FDIC coming in saying, hey, we got 250K for you, right? That's not an answer no one would look for, company or individual, right? So, but overall, where the biggest issue actually comes from is this comes from a system, and it's primarily linked to the fractional reserve system, which is what we use predominantly across. Banks have the discretion, but typically they can loan out or leverage about 90% of every dollar that they get. So when you have that type of extreme leverage, we're going to, even historically, we've seen this several times throughout history, but now it's becoming so frequent that it's really just buckling our economy with these bailouts and stuff like that. And for Powell, it's really putting him in between a rock and a hard place, because if his job is to combat inflation and say that, okay, well, we need to, raise rates and stuff like that, and how can you justify saying, we need to print, or we have this domino effect, because if we don't give these companies money, if they don't get it from somewhere, us or the hedge funds, these people are going to be out of work, and we're going to see this domino effect. And if people are getting out of work and companies are shutting down, that's a domino effect on down all the way down to the individual consumer. And eventually, those printing presses have to come back on. And then what happens to inflation? Back up again. And then, so we're going to raise rates even higher. And if we raise rates even higher, what does that do? That puts a strain on the available cash for what the banks can make, right? Because if rates are higher, what are we doing? We're not taking out loans. We're not buying houses. So the banks are making less money. And if these banks and institutions are already squeezed, we have a domino effect again. So this is really, really an interesting way to see how this is going to play out. If the hedge funds kind of swoop in and start buying these accounts up, or doing these swaps, basically, we could see maybe some alleviation to this level, but overall, it won't be the end all be all, because something like this typically takes time. But we can see a liquidity pull on the market, which is the biggest thing. We could see some of these institutions that have additional holdings, because I don't believe that they have all of their holdings like an SVB, but you can see that scarcity come in and say, okay, well, we don't know what the future holds, but we know that we're probably going to need some liquidity relatively soon. So we need to go ahead and kind of dump what we got. And then we can see that kind of take effect in the stock market. stock market. You'll see, probably crypto will be affected. It can really just kind of just topple over. And what we have to do as a consumer is to say, okay, well, we typically, as of right now, it's not affected. It hasn't affected us, but if this triggers a panic and we start seeing these bank runs like we've seen, there's some images circulating online right now, then if it trickles over to like consumer banks, that can cause an issue as far as for these bank stocks, because you've seen Bank of America is already at its 2021 low. Wells Fargo took a nosedive. Like all these, Charles Schwab took a nosedive. Like all of these institutions, they're taking nosedives, and now we have to ask ourselves, okay, what is their exposure to this? Is this all one big, loop? I'm not gonna say a Ponzi scheme, but all big one big loop where they're just swapping the cash. What's their exposure to this? Or is this just people panicking and dumping their accounts just because they don't know and they don't want to take the risk? These are things that we're going to find out, and it's going to be soon to come. But overall, we as consumers, outside of making sure that we are diversified, really, we have to kind of take account and say, okay, well, typically these things will smooth out over the long term. Personally, I wouldn't say I'm a gold bug, but I do believe in precious metals. I've been buying precious metals since I was around 15. I do like having that hedge outside of this. I'm not gonna say it's not like a dream, but most of our money, I'm not even gonna get into that in this video, but it's not real, right? So even only 3% actually exist in a printed form. Most of our money is numbers on a computer. So even if they did say, okay, well, we have all of our money, technically they can't have all of your money because it's physically impossible. So we have to swipe these cards if we want access to our cash. But overall, I think that going forward, if you are planning on taking out puts and shorts and stuff this week, just ultimately be careful, because any news of like a bailout or these hedge funds swooping in will send it the other way, and these things can kind of change with the wind as we get new information. But more than likely, we're probably going to see some panic this week. So keep that in mind. Be safe. That's my update for now. But overall, we'll kind of have to take this day by day as we get additional information. But as this unfolds, we'll see. But more than likely, you can probably expect a bailout in some kind of way from either the hedge funds or the government. I'll be really surprised if they let the banks just kind of, if they just kind of let this kind of resolve on its own, right? Because technically this is a practice that should have been happening all along, but they've snowballed it until now our debt is larger than our GDP. So it'll be a very interesting time to say, to start talking about liquidity and stuff like that. So we'll see. Not liquidity. It'll be a very interesting time to start talking about accountability and stuff like that. So it's something we're going to have to kind of gauge going forward. But overall, I think we're in for a very exciting week, and we will see. And I will certainly report back to you as I get additional information. Be safe, everyone.
Detroit.